Good morning, everyone. Welcome to our macro meeting, our weekly macro meeting on Domicios Macros Corner and the Goldfields Fund. I have some breaking news today. Just saw a video from Federal Reserve's Chairman, Jerome Powell, mentioning some political pressures arriving from this subpoena, the threat of a grand jury subpoena regarding a criminal indictment linked to the June, I think it was June 2025 meeting, and he mentioned the renovation of some historic buildings. So I think the market is probably not going to like it because it really threatens the Fed independence in some way, especially the way that the reaction came. So today we see the futures grinding lower. We wonder how this is going to impact the dollar here in the emerging markets. If the dollar is going to go lower against our currencies, or because of market stress, is it going to go higher? So soon we'll get to know that. Last Friday, we saw the employment numbers for the US, 50,000 new jobs created. So this number brings some stability to the markets, not a bad number. It's not a good number also. The market reacted with some strength on the dollar. I think people were afraid of a bad number. So after the number, the dollar firmed a little bit against major currencies, and probability on the CME, as we're going to see later on the presentation, moves to less easing. Not very much, but enough to move the dollar higher. We also have another highlight for this week is that Japanese rates are still approaching multi-year highs, even though their monetary base is shrinking. So this combination will probably bring some volatility to the exchange rates sooner or later, or will bring a crack to their real economy. And we will probably see some volatility on their equity market and exchange rates too. So this is something that we have to keep an eye on and watch it. So far, the yen has been losing value against the dollar, is reaching the 158 level, which put some pressure on China, and by consequence, put some pressure on Brazil also, because China is still our main source of exports. And in Brazil, we also had Friday the inflation numbers, consumer inflation numbers. We closed the year 2025 426, which is a good number, is inside the government's band of targets. So market reacted positively, real appreciated. 2025 was lower than 2024, which was 483. So the real appreciated once again below 540. We saw some brief stress in December when dollar real went to 560 due to seasonal pressures. It's typical in the end of the year. Companies that produce here in Brazil, foreign companies, send dividends and profits abroad, so they really pressure the exchange rate higher. And by the market's reaction, that we can see that this was the case, because after when we moved the calendar to January, the pressures were relieved, and the exchange rate came down again. Okay, so starting with US, we always begin with liquidity watch because everything is priced in dollars. So liquidity is the main concern for us traders and investment managers. So according to Cross-Border Capital, which does a very good job of following liquidity around the world, global liquidity has risen by 14 trillion last year, but the short-term momentum is slowing sharply. This is probably due to Fed and BOJ liquidity conditions and flat ECB and Bank of England growth. Those are all waiting on expansion. And on the positive side, we have stronger collateral values and lower bond volatility, okay? Because when you have a collateral that is very stable, you feel safe to use it as leverage on some risk-on positions. And when there's too much bond volatility, you'll probably be more conservative because your collateral is changing value all the time, along with the risk assets, and that creates a double risk. So the more stable your collateral value, the more liquidity you may have, the more risk on you may portfolio manager may be. Okay, so going forward, you observed at the end of last year some stress in the major money markets and collateral funding. This is the source of all markets. This is the main, like we could call it the twin pillars of capitalism, where the overnight secured overnight funding rate, which is treasury collateral operations, and also against private collateral funding. So the market was probably short on funds for a while ago because bank reserves were decreasing along with quantitative tightening, which has now ceased. And we saw some stress, and that could emanate to another areas of the market. So the Fed did a little intervention at the end of last year, and we can see that this normalized towards the zero level. So now everything looks okay, at least from this point of view. And liquidity sensible assets like Bitcoin have recovered a little bit. They were, because of this reduction in liquidity, the most sensible assets, they were falling in value. And now they have recovered a little bit this morning with the weakness of dollar because of this indictment. We can see that gold and silver are going higher against the dollar, which are typical hedges against the stresses like this. And Bitcoin is also climbing a little bit. We know that the reverse repo operations are near all their lows again. They were at very high levels after the COVID interventions and helicopter money. People had cash parked in their accounts, and the Fed had to drain this liquidity every day. But this money has been put to work either via money market funds to finance all the T-bill issuance that the Treasury has been doing, or has been put to work on other riskier assets. So this means that the cushion of liquidity is now lower than it was before. It doesn't mean that the market is going to have any problems soon, but it does mean that the cushion is much smaller than it was a while ago. Okay. And bank reserves we have to follow. It's another important number. This is the little twist that we saw at the end of last year, when the Fed intervenes to make the market more liquid. Still, it's just an intervention to contain some possible stresses, but it's not an intervention large enough to push another bull market or something like that. So we must keep an eye on this, because this, in the future, if this keeps going lower, we may see some stresses in credit markets and collateral funding. This is important to watch. Regarding money supply, we remember that after the big intervention of 2021, money supply was contracting. This is what caused inflation to go up, and this is what contained it afterwards. And now we are back into expansion again. But this is like a regular historical number. If regulators give more room for banks to expand their balance sheets in order to accommodate more treasury issuance, especially T-bills, and we see this number climbing higher towards 8 or 7, 8 or 10%, this may put some pressure again on inflation. For now, the market is very calm on this front. Inflation has been grinding lower, but we must keep an eye on this, because if this accelerates, this is a very good leading number in order to know that inflation is gonna grind higher. So far, everything looks fine, but we always watchful regarding this. Okay. This is total bank credit, also regular expansion. For a while, it was contracting when the Fed was aggressively raising rates in the past, but now it's back into expansion mode. Again, it is better in a Goldilocks scenario where inflation is low, the economy is growing at a steady pace, but not very strong enough to pressure inflation and make the central bank raise rates. The market likes this Goldilocks like growth near 5%, and so as long as this doesn't accelerate too much towards the 10% level, we don't see much pressure on inflation soon also. Okay. This is an interesting graphic I took from the Fed of New York. This is total debt balance and its composition. We can see that for the US, mainly most part of the private debt is composed of mortgage loans. We also have student loans, credit card, auto loans, HE, home equity revolving, which is still very small, but mortgage compromise most of the number. The total is now $18.4 trillion. It's been growing at a steady pace. I found it very interesting, so I decided to bring it to the meeting so we can everyone can see it. This is an interesting number. Still, mortgage financing is the largest number in private debt. Okay. Another interesting graphic. Everyone has been talking a lot about gold, and gold has been going up sharply since 2023 after geopolitical issues with the Russian reserves, the Russian dollar reserves. Some central banks started buying aggressively gold, mainly countries that are not aligned with US sphere of influence. And we like to measure gold against money supply because gold is priced in dollars also. Okay. And when we adjust the gold price for the M2 money supply, because the US Fed only releases number up to the M2, used to release to M3, but not anymore. Also, when we adjust gold for the M2 number, we are approaching the 2011 highs, not in nominal terms, but in real terms. And we are still a little bit far from the 1980s panic right here. In order to reach these levels, the price would have to double to like $8,000 or $9,000 per ounce. It could happen, but it's not a probable scenario, at least for now. Could happen in the case of a major war or something like this, but so far I don't think it's plausible. So we have reduced our gold holdings, which were major holding that we had. We are reducing it slightly per risk management. Dollar index on Friday after the employment number, they came back above their exponential moving average. And I think that 100 is a key level to watch, but this is like a sideways market for now. You can see that volatility has been grinding lower. After the dollar depreciated against major currencies, it really went into a sideways mode. Everyone is watching it. In my opinion, we will probably keep it this way for a while, unless there's some major new event. But the way things are going, the market looks very balanced right now. But I wouldn't be short dollars at these levels, at least against other major G7 currencies, because the prospects for US growth are still better than for other major economies on the G7 landscape, except for Asian currencies, which may be slightly undervalued, but against the euro, the pound, or other currencies, I wouldn't be shorting dollars right now, okay? The probability on the CME for the next meetings, so after the employment numbers, they moved to almost 100%. They are trading at 95%, but they were trading at 85% on Friday before the number. So now it has consolidated that we're not going to see any moves on the next meeting. But when we look for March, before the numbers, there was a split. You can say 50% stability up to March meeting, and 50% for lowering either 25 or 50 basis points. But after the number, this also helped strengthening the dollar after the number. Now the major probability sits on stability side. Only 30% now of chance of reducing either 25 or just 1% of 50 basis points. So this may help keep the dollar beat, okay? We also have to mention that tariff revenues have been grinding higher. If we analyze this number, we will have almost 400 billion yearly, which is very significant. It may help on the fiscal effort. And here we also follow closely the GDP nowcasting from both New York and the Atlanta Fed. After the international trade and wholesale trade numbers and the employment situation, the number moved sharply higher to more than 5%. This is very strong regarding the size of the US economy. And this is real growth. This is on top of PCE. So a very strong number. But when we look at the New York Fed GDP nowcast, it is closer to 3%. Last adjustment was higher from 2 to 260. They even show probabilities. There is a 60% probability that this number will range on the 1.16 to 4.17 area. Still, it's a very good number, still very strong. The last adjustment they mentioned, they also have a high frequency adjustment as the numbers are being released. They keep updating their numbers, but the last number was just, as they mentioned, adjustments in their model, which month-end adjustments that moved the number from 207 to 262. Still, it's a strong number, so this may also help the dollar. Okay. This number shows how real disposable personal income is still grinding higher. This is good for consumer sentiment. A number that is detaching from the rest is the leading economic indicators calculated by the Conference Board. It has a bit of delay now because the last number is regarding September, but we can see there's a big divergence here. Leading numbers are grinding lower, even signaling some possible recession, while coincident numbers are still grinding higher. So this is something we must keep an eye on also, because this divergence will soon have to either converge or show that one of them was wrong, and the market may move sharply in one of those directions, either considering that the economy will not weaken, there will be no recession anytime soon, and then the dollar will move higher, or employment numbers will keep weakening, and then coincident numbers will start to go down. But so far, everything is pointing on the direction of the economy keeping at a strong pace, at least growing on par with money supply, like nominal rates of towards 5%, which could be good for equities and risk assets, because too much growth, as I said before, may call the central bank attention to drain some liquidity from the market. So here we may continue on the Goldilocks path. We will see also, I mentioned that the inflation numbers were grinding lower. This is the Cleveland Fed's inflation nowcasting. So they have high frequency also for both PCE and CPI. You can see that the CPI is approaching central bank targets of 2%, PCE 2. And for core numbers, they are still slightly higher, but they also have been moving lower. So this is the market looks for the rate of change. If it's moving lower, the markets read it as optimistic. So yeah, this is one of the reasons why equities have been so bid also. Inflation was the main concern the last 2 years. Now that it's grinding lower, it puts a bid on risk assets. So, but we must keep an eye on total credit and money supply, because if it starts going higher, inflation may move higher in the future, bringing some stress. But so far, so good. Break-even implied inflations were very much close to the central bank's target. They were trading at 225 for 10 years last week, and then they grinded a little bit higher after the numbers to 228. Still is a very benign number, and this was mainly due to the fact that nominal rates ticked a little bit up, while the TIPS, Treasury Inflation Protected Securities, the yields moved lower. There were some bids on the market for Treasury Inflation Protected. securities. So uh, when we divide nominal rates by the inflation linked note rate, and then we get the implied inflation. So uh, numerator didn't change, denominator moved slightly lower, and the resulting was that the inflation, implied inflation, grinded a little bit higher. But this is no source of concern right now. I think we have to watch the 250 level. If some reason we break the 250 level higher, then the Fed will probably stop easing rates, and then there will be some stress in the market. But we are far away from that right now. Okay. Credit spreads. This is also a number that's signaling the market is still on a solid foot. We are approaching last year's and the end of last year's lows. This is mainly because the last 10 years, debt has been mostly absorbed by the public finances and public government. So, how can I say? After the 2008 crisis, mostly what has happened is that private companies that had a lot of debt, the balance sheets were cleaned, and the debt was transferred to the central government. And since the central government is now always, Treasury is always issuing new debts to finance their deficits, the large deficits. Uh, this puts some pressure. This is mainly a supply and demand issue, because Treasury is always on the offer for new issues, and the private sector is taking the chance to reduce its exposure. And so this is one of the reasons that the spreads has been compressing so much. We have a green light here, meaning that this is a goal for risk assets. Okay, if this number starts climbing up higher again, then we will have a risk off signal, but so far it's a risk on. We also can see the same situation developing on the junk bond on its clean price. You can see this is like a textbook trend higher. We are almost approaching new highs here. So another bullish sign for the US markets. For this week economic calendar, we have treasury auctions. We have the CPI on Tuesday, may bring some volatility to the market. Whenever the number comes lower than expected, there has been a repricing of equities higher. So here the chances are more, in my opinion, are more skewed to the downside than to the upside, especially because oil prices have been under pressure lower. On Wednesday, we have current account numbers, which are very important too. Employer State Survey on Thursday, initial claims, and on Friday we'll observe industrial production and manufacturing and capacity utilization. Okay. Still, I think the biggest impacts will be on Tuesday and Wednesday with consumer and producer price index. Now for equities, this week we'll start observing also the release of results from last quarter for some major banks like Bank of New York, Bank of America, Citigroup, Wells Fargo, BlackRock, and other important financial group, State Street. So we are opening now the season for reporting, for the companies reporting their results. This may put some, this may bring some volatility to the market too. Expected earnings for the S&P in 2026 are still showing more than 10% gains, and this has been the most. This has been the driver of this bull market. Like the companies are really showing better profits. Their profits have been growing surprisingly higher, and it is not only an issue of earnings expansion or compression. It really has been companies making more profits than before. So this puts the bull market on a solid foot so far. And if it keeps that way, we'll probably see higher numbers. I think that we'll probably go to 7,200 soon, and there we are looking to enter some hedges, buy some, depending on the implied volatility, we'll buy some hedges, some puts for our funds to protect our portfolio. And here we can clearly see from the work of I think this is from HSBC, if not mistaken, that for the US, most of the stock market returns, if we decompose it, it has been earnings per share growth, not multiple expansion like has happened in China. For other markets, we also have FX impact. So the US has been the strongest one regarding earnings per share growth. Here we have NVIDIA, still trying to be above their moving averages. If it breaks lower, then we may see a bottom stress. MicroStrategy, this is a Bitcoin leverage play. This is another good barometer of liquidity in the market, so we always keep an eye on it. Has been suffering as of late, along with Bitcoin prices, but of course this is considered to be a leverage Bitcoin position, so it is more volatile than the asset itself. This data comes from Dow Jones for the month of January. Historically, it is a good month for equities. So far, so good. We have confirmed this trend. January has been a good month so far for equities. And this includes the data for the major indexes going back several years. This is the S&P 500, the SPY. I'm using the ETF here, actually. But we can see this is also a textbook trend higher. We're keeping above the moving averages and steadily climbing with low volatility. This area, we know that the market is long gamma, this area, so probably when the market moves higher, dealers have to short their delta to cover their daily exposure, because the higher the market moves, the more delta they have to sell. So this puts some cap on realized volatility. So the market has been grinding higher steadily and with small realized volatility, okay? Due to the fact that the dealers are probably long gamma at these levels. Okay, so when we divide the S&P 500 by gold, we see that which means this is like the S&P in real terms, because gold is a more stable currency than any other fiat currency. And we can see that the bull market is not that strong. It's just strong in nominal terms, probably because the dollar has been losing its value. When we compare the S&P to gold, we see that the bull market is not such a strong one. Okay, uh, but this means that there can be some bullishness back up, uh, because the S&P in real terms is on a short term maybe oversold. Okay, now when we compare equities to bonds, this is a SPY MTLT, which is an ETF that represents total return for a 20 plus year portfolio of bonds. When we divide one by the other, it's amazing to see how equities have moved higher and bonds have stabilized or moved lower during the last years on a very strong uh, American economy. This number signals that this is a strong America where rates go up, but equities keep going up at the same time, because the economy is still growing and they can withstand the shock of higher rates. This is also related to deficit funding, because the deficit funding, uh, the deficit that the government is doing keeps the economy, also the real economy, on a solid foot, and profits are grinding higher. So it's the number has been really distorted for, if we compare against the average of the few years. This may bring some, uh, how can I say, not a. Uh, we have to observe that this number may be some. We have to be careful, because if rates start to move higher from here, at the level that the equities are, because the ratio is so much higher than it was a while ago, we may see some profit taking. But so far, so good. Brazil has experienced something similar. Uh, the rates moved higher, but equities never collapsed. In fact, they also kept going higher. So I wonder if this isn't just a supply and demand issue, because here also the government is also always supplying paper to fund their deficits, both in the U.S. and Brazil also. And equities have been. We also have, in Brazil we haven't had any new issues for a while, but in the U.S. we do have. But since the earnings have been growing and the market has been bid for other reasons, uh, this means that the market is still very strong. The rates haven't been able to pull equities lower. Okay. Mm, we always watch some major sections of the stock market to try to infer how healthy the situation is in the real economy. We like to look at the ETF that represents big banks, the KBWB index. It is reaching new highs, signaling strong economy. Also, regional banks are on a strong foot. Housing, home builders, X, HB ETF last week, after the good employment numbers, there was a huge volume. Market very well bid, moving sharply higher, going above the moving averages. This is a bullish signal also. Walmart, another proxy for consumer activity, has been very bid. as of late. So another bullish sign for real economy. And the S&P, with all this bullishness, has kept pace with the monetary inflation. When we divide the S&P by the M2 money supply, we can see that it has preserved the investors' capital. We are approaching now the 1999 highs, which brings a little bit of a concern. So for risk purposes, we can, as I said, we'll soon be looking forward to buy some hedges. One of the reasons is because of this number. Another bullish number has been volatility. Implied volatility has been on the move lower lately. So we'll probably take the chance to buy some hedges. This is another title here is slightly wrong. This is realized correlation. Realized correlation on a 1 year look back, it moved sharply higher during the sell-off of tariffs in April 25, as it always usually does. Now, when the market has a big sell-off, everything moves in tandem lower. But now we will come back to the environment where idiosyncratic risks take place and people try to generate alpha, diversifying and trying to concentrate in some sectors as opposed to others. This means that the realized volatility has been grinding lower also. And now we look at the CME implied correlation for 3 months. Is also moving lower. I think that if this number moves, the implieds move lower than 10%, it has always been a red flag that the market is too relaxed or lax in terms of risks, and it presents an opportunity to buy hedges on index options, because index options are cheap relative to single names when implied correlations are low like this. So if it moves towards single digits, then I think this will be a big red flag for risk assets. We'll probably cut our exposure by more than half. Okay. The skew structure is another thing that I tend to disagree. I don't think that if we ever move towards the 90 deltas, which are much lower strikes, if the market goes there, I don't think that the implied correlation is going to be only 30%. We'll probably go to 50 or something like this. This is another indication that we may have an opportunity to buy index hedges. Implied correlation term structure, another one is whenever the structure is like this, is very heavy on the front end, and the long end is still higher. It means that the market is very calm. It feels safe to sell short-dated options, and we know from experience that these things can reverse very sharply if there's any news that the market is not expecting. So this is another number that brings some conservative stance on our side. So now we finish US, and then we move towards international markets. Italy has been upgraded recently by credit agencies. I think probably it was Fitch was the last one. It is an unusual situation to see Italian bonds trading lower than French bonds. France and UK, they have become the ugly ducks regarding fiscal their fiscal policies, and Italy has been cutting expenditures and adjusting their fiscal numbers, and so they have been greeted with upgrades, as opposed to France, which is on the verge of losing investment grade status if their debt gets downgraded once again. I would watch the 360 level. If the market breaks above 360, 365 new highs, then we'll probably see some stress here emanating from this market. So far, it is keeping pace with the rest. Their equity indices are breaking new highs. This is very bullish. They export a lot of luxury items to China and Asia, and those markets we know that are still buying a lot from them. So the market has been bid for all European indices. Also from diversification from investors. Everything was so concentrated in the USA for the last years that I think it's natural to see a movement, a risk-on movement towards another other G7 markets, their equities, and also emerging markets. One thing of slightly concerns us is that the PBOC was injecting liquidity in the past, at least until October, I think, and now they have reduced those liquidity injections. The reason is not clear why, but the fact is that they have been reducing it, and there's less liquidity sloshing around. Another way to measure how their liquidity is going is to look at iron ore prices. Those have been on the climb, which is good for Brazil in its exchange rate, and also Vale, because we are, I think, our third or fourth major export is iron ore, and so we had this for a while. We have been commenting on this setup, which has been, the dollar was very strong a while ago, then it started weakening. So lower rates on the dollar would lead to a stronger GPY that would lessen the pressure on the yuan, because both economies compete. They are very competitive in exporting, and this would later translate into lower rates in China because of a stronger yuan, and then the stimulus would come, and this would be good for other emerging markets. It was happening like this, exactly like this for a while, but now the liquidity injections have slowed. We'll probably have to investigate the reason for this, but this is the setup that also is good for the emerging markets, especially Brazil. But the yen lately has been weakening. If we go back to 160 level again, I think the market will probably stress about it. This may put some pressure in the yuan that has been steadily moving higher, meaning that the yuan has been getting stronger. Bond yields in China. This is after reaching multi-year lows of 165, it has come back to these more regular levels of 190, but still it is a very low rate. Chinese bonds have been a good asset for the last years, as opposed to other G7 bonds. Investors made money on this for the last years. For all the other bond markets, the major bond markets, this has been a really bad trade. bad investment so far as opposed to equities. Only the Chinese bonds have been a good alternative because China is seen as being in recession, not recession, but it's growing much less than its potential. And then the rates have really collapsed. Concerns in real estate and infrastructure, everything that we already know. So here it is, the exchange rate is being moving steadily lower. This has also helped the real to appreciate. Their equities is on the bid also. We may be on the start of a new liquidity cycle in China. We don't know yet, but can be the case. China has been moving on an opposite pace regarding liquidity when you compare it to the US. The US was expanding, they were contracting. The US was contracting, they were expanding. And now they may expand again. And the US, I wouldn't say it is on contraction mode, but at least it is not expanding on the pace that it was in the past. Emerging market, this is an emerging market currency index that the Fed calculates also appreciation and portfolio flows for emerging markets again. Here we have the Euro Norwegian krone, which is also a proxy for oil strength and weakness. The market is relatively calm here. This means that the market is not envisioning any panic for or big sell-off in oil prices too soon. After the U.S. captured Venezuela's Maduro, some people were commenting that the oil prices could collapse by 4 or at least 4 or 5% more, but they were on the rise. So, and also the disparity is in tandem with that, meaning that the market is not forecasting any major sell-off in oil right now. In UK last week we saw a sharp contraction in long-end yields. The UK was trading above the dollar. The yield in pounds was much higher than the dollar. This is an unusual situation. And now, after some inflation numbers in the UK, the case is the same as in the US. The market really believes that inflation numbers will come lower. They will be lower on the foreseeable future. So a big bid for UK bonds last week, and almost a 20 basis point contraction. This is a big move, and the pound hasn't moved too much. It is like on a sideways market between 136, 37, and 130. We are right now in the middle of the way, so nothing to do here. Germany, after they announced that they would spend more on defense and military spending, rates moved sharply higher, and they have been steadily on the rise. You can see that this 290 level is a big resistance. If we break this higher, the market may show some signs of stress. We'll see, because if rates move much higher, you know that this will start attracting capital from other risk-on assets. I think we have to watch this 290, 295 level. This, technically speaking, is important pivot. Also for Germany, new highs in equities. The market is very well bid here. And the euro is behaving like the pound, is also on a sideways market. I don't think there's much to do here. And Japan, we mentioned that Japan, their GDP contracted because money supply has been contracting. It is a weird situation where we have GDP contracting, money supply contracting, but rates are going up. This is probably a way to contain their inflation, but it's also a dangerous combination that may bring about stresses in the future because you don't know if you push it too much, too far, you may cause a crack in economic activity, okay? So this is the ratio, yearly ratio for money supply. Is last December was contracting on a yearly basis 8%. Big number. The 10-year also near its highs, 2.10%. It is amazing because we haven't reached that level, I think, in more than 10 or perhaps 15 years. So this is a major thing you have to keep an eye on. If you have a combination of higher rates, higher dollar exchange rates, then Japanese investors may feel compelled to start bringing back home some of their funds, selling equities and other risk assets all over the world, and bringing their money back home to invest in government bonds. So this may put some pressure in the markets in the foreseeable future. We also have to watch it. And their equity, since the balance sheets of their companies has been cleaned since with all this money printing after the collapse of the 1980s and 90s. Companies there nowadays have very little debt. Their debts, their balance sheets have been cleaned up. So this paved the way to a big bull market in Japanese equities. But since they have moved sharply higher, I think that with money supply contracting and rates on the rise, we are also creating some dangerous situation here. But for exporters, it has been a very good environment. So another thing to keep an eye on, Japanese markets will be on the spotlight, I think, in the foreseeable future. Oil. We mentioned before, the markets thought that after Maduro's capture, this level would be reached lower, but never happened. Market is now slightly higher. But there has been so many new discoveries and supply coming into the market that we'll probably have some equilibrium here in the foreseeable future. The only thing that concerns me regarding oil prices is that oil has become relatively cheap to currency commodities like gold and silver. We are almost at COVID lows. So this is, I always like to look at the relatives. So this may signal that oil may be very cheap. And the chances here, you may be looking more or looking forward to be on the long side more than to be on the short side. Gold, with all geopolitical pressures and the afraid of monetization of debt in the foreseeable future, gold has been on the rise. It has been a favorite position for us for a while, but now we're reducing it due to risk management. Copper also breaking to new highs. This is due to grid electrification of cars. Copper is one of their main components. Aluminum also has been on the rise because aluminum is a cheaper proxy for uh, electric um, electricity transmission. Copper is a better component, but things get more expensive. So sometimes you may replace material, you may substitute copper for aluminum in some uh, cables. So aluminum as a is also an electricity transmitter, and has been on the bid also. Silver, we are reaching almost mania levels now on the 80. Uh, we had a bullish prognostic for silver because their prices were low for so much time, and still 50. We saw $50 in 1980. So if we adjust that by money supply, and the numbers will be much higher today. Even though the 50 level was the top of the 1980s, it was nominal. And if we adjusted on real terms, the spike could be much higher in a stress situation, okay, on a mania situation. Soy numbers, soft commodities have been performing poorly, just a sideways market. Wheat, same thing. Now that we finished international, I think that the conclusion on international is that equities have been bid all over the world, even though bond rates are on the rise. We are repeating what happened in the US in the last few years. Currencies, we have a neutral stance, equities positive. Commodities, soft commodities have been weak, and financial commodities like gold and silver have been bid because of geopolitical tensions, central bank reserve diversification away from the dollar. Everything that we know is on the press. Soft commodities have been uh, moving sideways. It's important to watch soft commodities because they may cause some stresses in countries that need to import food, because after all, those are food prices. So for social unrest, if these prices climb much faster, we may see some social unrest, but so far it's okay. And now we go to Brazil, last part of our meeting. In Brazil, we have Lula da Silva leading for 2026 election. Flávio Bolsonaro last week moved slightly higher. Tarcísio de Freitas, which was a major contender before Bolsonaro announced his support for his son Flávio, Tarcísio was leading, and now has sharply reversed. But Lula still is the favorite. We I don't have much of an opinion here, but all I know is that this will bring about much volatility for Brazil because they are much different from each other. Those are more market-friendly candidates, and Lula has been viewed as more fiscal lax and more. He's leaned more towards more government deficits, uh, not too much control on spending. So uh, if this candidate starts to gain some traction, and then it's a bid for Brazilian assets. I'm not sure what will happen from here if Lula is re-elected. Probably we'll see some stress, but we have a lot of time to the election. A lot of things will happen, and we have to be careful because lots of volatility on this year for Brazil, is my prognostic. Equities in Brazil, this is a work from BTG. The 12-month for P, excluding Petrobras and Vale, is only 10.6, attractive level, close to the lows. If we include Vale and Petro, it's 9.1. But the earnings yield is not on the lows regarding equities because real rates on Brazilian bonds have been on the rise along with equities. So if the real rates on bonds were grinding lower, then the earnings yield would probably be more attractive. But because both have been climbing, the equity prices and bond yields, then this graph here doesn't look so attractive, okay, as opposed to this one. We have seen cumulative flows to Latin America and emerging markets. Weekly flows have become positive. Global emerging market funds flows have been also positive. They have an accumulated number for 26 on the positive side. For Latin America, strong inflows during the week. This is helping our markets to be supported. On a daily basis, we can see foreigners here on the bid, institutional players selling to foreigners and retail accounts, and banks also supplying the markets. We already mentioned that JP Morgan, now Goldman Sachs is also on the tape saying that Brazil will cut rates and placing Brazil as one of their top picks in emerging markets. Regarding foreign exchange, we saw once again a negative FX flow in 2025. Trade balance brought almost 50 billion of inflows, but this was offset by 82 billion of outflows via the financial segment. So this marks the second worst net result in the historical series, surpassed only by 2019. Wow. It is curious to see that in 2019, it was before COVID, and we had Bolsonaro elected, which was considered a market-friendly candidate. And even though those things were happening back then, we had the largest outflow ever right before COVID. And now the second worst number on the series. But due to the carry trade and the central bank reacting accordingly and pulling rates up, the real has managed to strengthen against other currencies. So even though we had these outflows, our exchange rate hasn't moved much because of the carry trade, as we can see here. So those outflows mentioned here by BTG on December, they caused this sharp move higher in December, but now the market is correcting itself. And we have to watch the 530 level. If we break this number, we'll probably go to 520 and then 5. I would be looking to start buying around these levels to diversify portfolios from real, mainly for Brazilian investors. But here I would be on the sidelines. I think we are on the middle of the way. This is some work that I do. I adjust exchange rate starting from some points in time, major inflection points like the 2008 crisis. I adjust the currency exchange rate by real inflation, which means monetary inflation. I use M2 because US releases M2 numbers only, and Brazil has up to M4, but then we have to compare apples with apples, so I use M2. It is close to what it should be. We would have 574 for using M2, and the market is trading now at 537, almost here. If we start from the lows of 2011, then the story will be different, but this was a major low point. But I always like to uh, have both situations, starting from the low point and from another points. And if we place our starting level right before COVID, then the dollar real could be trading at 7, because Brazil has created more currency. The US had a period of contraction in their money supply after 2022 and during 2023. But we, on the other side, we reduced our currency issuance, but never, it was never negative. It wasn't contracting. Okay. If we start from 100 in both currencies, US now is 50%, 57% higher, and we have more than doubled. Here we have this ratio, which I make a joke called Uncle Domicile ratio, which is, one thing is to look only at the M2 numbers, and another thing is to look at M2 expansion against the overnight rate, because if you're expanding, like the Brazilian example, expanding at 8 or 9% clip on the M2 money supply, but you have overnight rates at 15, you're still having some advantage holding the currency, because in real terms you're earning something. And so here I call contraction when the overnight rate is above currency issuance, and expansion when, especially during COVID, when there's a lot of currency being issued and overnight rates are kept on a much lower level. We adjust that to see where the currency should be. And in that situation, then the real should appreciate as opposed to the other one, because the carry trade has been heavily skewed for the real. If we sum up all the areas here, the red areas are for the US and blue areas for Brazil, even though Brazil is much more volatile on the expansion and contraction cycles. In the end, it has been more favorable to hold reais than dollars in this situation. And that's one of the reasons why the carry trade has been a killer. More against the euro than the dollar, but because Brazil, like a metaphor for that is that Brazil has been a car that is stepping on the brakes and the accelerator at the same time. We issue more currency, and then we have to have a higher overnight rate to control inflation, which doesn't make much sense for me. But anyway, it is fact is a fact. But we have been behaving like a car that is stepping on the brakes and the accelerators at the same time. This is a graphic that has, we are zooming in this. This is a longer term from 2002, and this is only from 2013 on. And here I will release the graphic next week, but I will also do a short video only on this matter. But if we adjust the currency pair for this ratio, then it should be trading lower, because the carry rate here is really in favor of the real. Of course, this hurts the public finances because uh, high real rates and high overnight rates, they have a cost, a large cost, and this is the main reason why the nominal deficit in Brazil is so much higher than primary deficit. Rates expensive to finance this high Selic rate. Here are the Brazilian main exports, so we can see that oil is the Brazilian main export nowadays. Then after, in second place, we have soy, and then we have iron ore, and then beef. Okay. Uh, Fiscal numbers, as I mentioned, the recurring primary result for Brazil, it is ranging, it is 1%, which is better than the US number, sitting at 3.5. But when you look at nominal, because the US pays less interest, they have a primary of 3.5 and a nominal of 6.5, 7%, as opposed to Brazil that has a primary of 1, and the government finds some extra revenues to try to bring it to 0 on the primary, but the nominal deficit is much larger, 9, sometimes 10% of GDP, which is a really big number and a worrisome number also. But this is mainly because of high interest rates. So if a market-friendly candidate gets elected, this could be easily reverted because then the market would give him room to lower rates, and lower rates would make the economy grow faster, and then we would enter a positive cycle, positive feedback. Uh, Lower rates, better fiscal numbers, more economic growth, bigger chances of repaying the debt, etc., etc. But then we have to have some conviction on the side of the market that the candidate is a really fiscal hawk. Okay. Mm. Here we can see for Brazil, whenever there's a divergence where you have, like, for example, in COVID, when the supply starts growing, uh, starts moving sharply higher, the rate of growth, and the government tries to force overnight rates down, the currency loses value instantly. Okay. After the COVID situation, the central bank quickly adjusted to uh, try to avoid inflation numbers spiking further than 2 digits. So money supply started contracting, Selic rates higher than money supply rates, the real started strengthening. We can see it here. It is zoomed in. It is clearer. We had a divergence here, so money supply was on the rise. Selic was going lower. The currency responded with a depreciation, and then the central bank reacted, hiking the Selic, and money supply was controlled, and then we had this sharp appreciation on the real. Nominal GDP for Brazil has been on the 7 to 8% range, which is much lower than the 15% Selic. Then we believe, because these two numbers on long term they converge, we believe that there's an opportunity here. Rates will probably be lower on sometime soon. So here we have the average for since the real became a floating currency. 6.20% IPCA. The overnight rate, the average almost to 12.60, but the money supply has been growing. The M4 measure 13.30. This gives the system some stability. Since Dilma Rousseff was ousted, if you take the same measures, IPCA has been slightly lower, overnight rates much lower, but nowadays they are sitting on 15%. The monetary base also lower rate of growth, but now the numbers will probably, IPCA is lower, but overnight rates are higher. So we are on a sharp contraction mode. That's the reason that I think that most big banks are showing up forecasts of lower Selic rates, some more aggressively, some less. The thing is, because of this contracting, expanding mode, real estate in Brazil nominally has moved higher, but it hasn't kept pace with money supply. So we have an opinion that some real estate exchanged funds, the Brazilian equivalent of REITs, are cheap, because if we adjust them by money supply, we can clearly see here they have been on a downward trend. And if interest rates start to go down, this can reverse quickly. So we are starting to buy some real estate exchanged funds for our portfolios. And here it is. This is a ZAP, FIPE-ZAP, which is equivalent to the Zillow index in the US, measures online prices for real estate, for houses, apartments, and etc. And this is the ratio which I made a joke called Uncle Domicio ratio, which is, it is just overnight rate less money supply. Whenever we are in negative area, means that Selic is higher than money supply issuance, and then we are on a contraction. And we can clearly see that expansion pushes the rate of change in real estate prices higher. Contractions reduce their price expansion to zero. Here during COVID, another expansion, afterwards a contraction, another brief expansion here, and now contraction and lower, much lower rates of growth in real estate. Even though we are always nominally always grinding higher, the rate of change changes through time. Okay. Implied inflation for Brazil 10-year. It has been trading stable, close to 6%, which is close to the average that we just mentioned for the real during the real period. But the front end is much lower, especially given realized inflation is lower than this. There's still some stress pricing here because of this is mainly due to the fiscal situation. Either we have a candidate is viewed as more market friendly and more fiscal restrictive, or Lula changed his stance. This is not going to go much lower. So we can see here, after a sharp move upwards, rates in Brazil are sideways, 13.5 for 8 years, nominal terms. For 1 year, 13.76. So we have some reduction pricing because the overnight rate is 15%. And here we can see the curve, spot curve, and the FRA. So the FRAs are pricing a reduction of Selic CDI to 12.30. This means 250 plus basis point reduction. This is the same thing, but closing with a zoom. And here we do a small calculation that if Brazilian Central Bank cuts 50 basis in March, then accelerates to 75 in April, June, and gives another 50 in August and September, concluding a 300 basis point cycle. The January 2027 DI future is trading at 13.76. If this really materializes, then we have 58 basis points to gain, being short rates here. Okay. Here's the graphic, the nominal graphic of the Bovespa. It's been rising steadily. But when we adjust it by money supply, it is still cheap. The EWZ is breaking a multi-year trend line. Their trend line is breaking higher, so this is very bullish. When we compare to DEM, which is the global emerging market ETF benchmark, we can see that the WZ, the Brazilian MSCI ETF, is still has some room to revalue higher. Compared to Mexico, the same thing. And compared to gold, even it is approaching multi-year lows. So anyone that has been holding gold and wants to exchange it for Brazilian shares will buy much more shares than they used to buy in the past. Comparing to US small caps also. And when we compare our small cap index to bonds, long term, because of same thing, supply and demand, small caps look cheap. Here is a longer term comparison between small caps and Brazilian fixed income index. You can see that we can easily double from the levels that we are if there's any indication of better fiscal policies. So definitely we are on the bid for small caps in Brazil, okay? Corn, sideways market in reais. We watch it because of inflation numbers. Coffee, after sharp movement upwards, there has been some consolidation here. And that's it. Well, for Brazil, we still, it is the same thing. Everyone is waiting for some signalization in terms of better fiscal policies by Lula or a pro-market candidate being better ranked on the polls. This would be a signal that the small cap market and interest rate market is waiting for. The exchange rate has been on the rise, at least due to better inflation numbers and also the carry trade. But still there's some room for our assets to appreciate as long as we solve the fiscal situation, okay? But we are buyers of small caps here, and we will be looking forward for to buy some hedges in any dips on implied volatility, because I think this is going to be a volatile year, either up or down. So, and because the US has been on a steady climb and the vols have been collapsing there, we may look to may buy some hedges there also. And this is it. This is the end of our weekly meeting. I hope you liked it. Any questions, will be here to answer. And thank you for your audience, and have a nice week. Good luck on trading, everyone. Bye bye.